Welcome back to the Rise Report. On paper, Charlotte still looks like one of the most oversupplied markets in the country, but the numbers are hiding the real story. Almost all of that new supply is brand new Class A product with high vacancy, and the Class B properties that we buy at Rise48 have much higher occupancy. Today I'll show you where Charlotte is headed and why investors are still moving into this market. Now, a tighter vacancy rate only helps you if demand holds up. So let's look at what's filling these units. Over the past year, Charlotte renters absorbed about 5% of the entire existing inventory. That's second in the country behind Austin, ahead of Phoenix at 4.7% and Raleigh at 4% against a national rate of 1.9%. That's not a market losing people. Underneath that, the local economy is doing the work. Charlotte added jobs at 1.2% over the past year, while the country was essentially flat at basically zero, and its population growth ranks third in the nation. The fastest growing sectors here are education, health services, and financial activities. Now you can see that on the ground. The Pearl, Charlotte's new life sciences district in Midtown, opened its first phase anchored by the Metro's first 4-year medical school through a Wake Forest expansion, and Atrium Health is putting $168 million into an expansion near UNC Charlotte. Healthcare and education don't lay people off when the cycle turns. They're the kind of employers that hold demand steady while a market digests supply, and that's the risk you're most trying to protect against here. Now, Class A oversupply does have a real impact on Class B in the near term, and it's something you have to account for. When brand new Class A product is sitting at 13.4% vacancy, those owners get aggressive. More than half of all Charlotte properties offered a concession last quarter, and in supply-heavy submarkets, 2 months free rent is common. What that does is shrink the gap between new and older product. On asking rents, Class A runs about $319 a month above Class B. On effective rents, after concessions, that gap narrows to $214. So for a couple $100, a renter can move into a brand new building, and a lot of them did that. Absorption in 3-star properties fell by nearly 3/4 year over year, and stabilized vacancy across the market rose 110 basis points to 8.9%. Now, the reason we're still buying in Charlotte is that those concessions won't last forever. 2 months of free rent is what an owner offers to fill a brand new building, and Charlotte is running out of brand new buildings. Construction starts are down more than 60% from their 2022 peak, and deliveries are projected to fall more than 20% this year. As those Class A buildings finish filling up, the free rent goes away, the gap between new and older product widens back out, and Class B gets its affordability advantage back. The capital markets are already voting on this. Properties built since 2020 made up about 35% of Charlotte's sales volume last year, down from 45% the year before, with an increasing share of deals going to stabilized 2000s and 2010s vintage product. That's capital rotating toward exactly the vintage we buy. In April, a 1991 built property in Gaston County traded at $177,000 a unit on a 5.85% cap, more than 30% above what the seller paid in early 2024. Buyers are competing for this asset class now, while the headline number still looks ugly. So that's Charlotte, an oversupply problem concentrated in a class of product we don't compete with, a supply wave that's mathematically ending, and demand that ranks near the top of the country. I brought up the Pearl as Charlotte's new life sciences bet. 2 hours up the road, the Research Triangle has been running that playbook for decades, and its supply picture looks nothing like Charlotte's. Next week, I'll show you where the triangle sits in its cycle and whether the same opportunity is open there. I'm Zach with Rise48, and we'll see you next week.